All right, welcome to the next edition of the Maslow Wealth Barside Chat. As you know, my name is Matt Jachimiak. I'm the Chief Investment Officer as well as a partner here at the firm. Joining me again is Isaac Thompson. He's our portfolio manager and also a partner at the firm. How are we doing today?
We're doing great. We're doing great. We're hearing a lot of questions around SpaceX and the IPO. What should we know about that?
Wow, yeah, it's going to be a really busy summer. It looks like. Just doing some quick work on ChatGPT, you'll see that there's anywhere from about a dozen or so major IPOs that are under consideration. Some that are a lot farther along, where they've filed their S1 with the SEC. The big one that obviously everyone's been talking about is SpaceX, but we've got everything from AI infrastructure, fintech, to defense and space. And so some of the other names would include like OpenAI, Anthropic, Klarna, Databricks, just to name a few. And a lot of these are going to be pretty significant in terms of market capitalization. So we look at it and it could be really exciting because this is a market for the last couple of years we've been talking about where capital formation's been really difficult. And so it feels like maybe if this IPO market really thaws, it could be really beneficial for everybody and investors. And so, for example, like SpaceX, which by the time most people see this video, might actually already be public. They're looking to raise anywhere from about 40 to 50 billion dollars, and that's just the amount of capital that they're looking to raise. That's not the actual market capitalization, what the company's going to be worth, which could be in excess of $1.5 trillion. So if we look at that 40 to 50 billion dollars that they're looking to raise, that's actually going to be larger, or at least match, all of the IPO activity from 2025. It's kind of ridiculous. So it's significant. We're not going to discount it at all. Like this is a thing that's happening, but it's also it's a blessing and a curse because some of these valuations could be really rich. I mean, are these companies really worth multi-trillion dollars? I'm not sure.
So how do we think about IPOs for client portfolios?
Yeah, it's a great question, and I think I break it down into two kind of primary questions. First would be, should you buy in at the IPO or not? And I think, if you asked us privately, like unequivocally, we would say no. Like majority of the gain that you get in an IPO isn't on that first day. It's happened years before when SpaceX was, a non-multi-billion dollar company when it was just a couple $100 million. That's where the value is really being created. Secondly, if you consider, there are people on the other side that are selling the stock. Insiders aren't selling the stock because it's cheap. They're selling it probably because it's fairly valued, if not a bit rich, or maybe really rich. Another way to say expensive. We think of IPOs as really market timing, and as you know, our philosophy about market timing is to
Always avoid it.
always. There you go. That's the best way to say it. We think again the better way to play these sorts of markets and companies is really to invest in private equity, and it's been a theme that we've been on for probably half a decade now, where we're telling investors you need to own private equity. It is a piece of a globally diversified portfolio. You'll have public stocks, you'll have private equity. Private equity has the ability to buy into these companies when they're very small, so you participate in all of the growth along the way. Additionally, you'll get the benefit of that IPO, whether it's a success or not. So then the next question is, if I'm not going to buy it at the IPO, when should I buy it? Well, the first thing that I would say is you probably need to let the stock just calm down after the first couple of days, maybe even a couple weeks, if not a month or two. Because these companies are going to be really volatile. There's going to be a lot of people either wanting to get in, a lot of people trying to get out, and it's going to create a lot of noise, a lot of volatility. Great opportunity, but I think it's one of those where you're just better off staying away. Now, the benefit here is that when we're talking about like the Anthropics, the SpaceXs of the world, these are going to be such major companies, and from a market capitalization standpoint, they are going to be big players. And so you're going to own it, you just won't realize that you own it. If you own a globally diversified portfolio of public stocks, within the next couple months, you will probably own it because the indexes will have to adjust. They will start to include them in. In fact, we've got like the S&P 500 and the Russell who have already contemplated adjusting their addition rules for stocks into their index because of these major IPOs. So don't worry, you're going to have this exposure. It's just a matter of time. So that's what I would say. All right, well, enough about the boring stuff like IPOs, SpaceX, and all that. Let's talk about what people really want to hear, Isaac. Tell us what's going on with interest rates.
Yeah, I mean, you joke, but interest rates are in fact the first thing I'm looking at every single morning when I'm looking at the market. And the reason is, it is the cost of capital. It is the cost of using capital to, consummate an economic transaction. If you think of buying a house, you're going to borrow a bit of money at some set mortgage rate, interest rate, and if that rate is higher, it's going to be harder to buy that house. Transactions become more difficult. And this is something that we see across, not only real estate, but corporate growth acquisition as well. Higher interest rates make investment in growth and transactions more difficult. And a lot of the liquidity issues that we've seen across a number of these markets is really related to higher interest rates.
Great. So what's going on with just interest rates as a whole? And I know there's a lot of things wrapped into that with maybe a new Fed chair, but there's a lot of action. What's going on?
Yeah, I think the big story is that the term premium is back. And when we say term premium, we're just referring to the fact that longer dated debt has a higher interest rate than shorter dated debt. We often refer to this as an upward sloping yield curve, but it's just the graphical representation of a shorter term interest rate being lower than a longer term interest rate. And we're seeing this because the Fed is in control of the short term interest rate and they're holding things relatively low, kind of in that mid 3% range. We do have a new Fed chair. We'll see what he does, but ultimately the market will have its say in that as well. As we step out a little bit, we're seeing the 2 years closer to 4, the 10 years closer to 4.5, and the 30 years closer to 5. So you can see that as the debt maturity kind of extends out, the interest rate, the yield is increasing as well.
Interesting. And that's kind of a departure from what we've seen over the last couple of years where it's been flat, maybe even a bit inverted. So what is pushing on those outer rates?
Yeah, absolutely. And it is a change. Inflation remains a little stickier above the Fed target. And the go forward expectation, I think, remains to have kind of a higher inflationary period. We've seen a number of kind of one-off supply shocks, with the most recent one being the Iranian conflict. But the other thing that's pushing out on the longer end of the curve is the deficits that a lot of the Western governments are running. We don't know exactly how that's going to end, but if you're talking about 30-year debt, at some point that's going to have to play out, and that uncertainty is kind of pushing up the rates there. The other big factor is the debt issuance from these companies. Similar to what's driving some of these IPOs, this AI data center build out requires a ton of capital. The IPO is a way of raising equity capital, and the bond market's a way of raising debt capital. You're seeing a lot of these Mag 7 hyperscalers issue debt to help them fund their data center build out. And a lot of that debt is being issued at 5, 7, 10-year maturities because it takes a little while to build out a data center and start to develop a return on that investment to refinance the debt. And so you kind of have these twin forces of stubborn inflation and a murky long-term inflation picture, as well as large debt issuances for this AI data center build out.
Yep. You're right. I was wrong. Interest rates are exciting. Well, again, thank you for joining us. This concludes our next Barside chat. But as always, if you have any questions that you would love for us to answer, we'd love to hear from you. Either reach out to us directly, reach out to your advisor. We'd love to answer any questions that you have, and we're always here. So thanks.